So, first of all, why do you think real estate developers, particularly those investing in multifamily, which a lot of our listeners do, why should they pay attention to the cost segregation?
I think this podcast is called Passive Cash Flow or that
That's right.
cash flow, cash flow,
Passive
cash flow,
cash
cash
flow
flow.
That's right.
Yeah.
Passive cash flow podcasts.
Well, and that's where cost segregation comes into play. It's a cash flow tool. Now, what we're doing is kind of taking a step back because I'm not sure how many of your listeners know exactly what cost seg studies are, but it's what we're talking about residential real estate. Most people know you go out and you buy a piece of residential real estate and you depreciate that over 27 and a half years. You separate out the land and you get a little bit of a depreciation deduction every year.
Mhm.
You also know, most of your investors know this, they go out and they buy a piece of equipment for their business. They get to write it off quicker, 5 years, maybe take 179 on it, maybe bonus it out, something else. Well, what the IRS says is parts of your building are more like that piece of equipment you just bought than they are the building. So the idea of a cost segregation study is to pull those out, which then creates a short-term reduction in your taxable income because you're pushing those depreciation deductions out of that 27 and a half into the current year, which then creates cash flow. Now, some people go, that's timing difference. I'm getting those deductions anyways. Most of the people investing in real estate know the value of timing differences. They know, hey, you can get me some cash today. I
Yeah.
can reinvest in something else. I can pay down debt. I can pay off a loan that I took out. There's a lot of things you can do with it once you know that you have that cash in your pocket.
Absolutely. Well, the lazy 1031, for example, I just did a masterclass on that, a passive investor
Mm-hmm.
masterclass, and it was very popular. A lot of people were interested in that. It's interesting, you basically sell an asset, you have a liquidity event, you have a taxable income, capital gains tax, and then you buy another asset in the same calendar year, and you do a cost segregation study on that new asset. You essentially use the bonus depreciation from the new asset to write off the capital gains on the past asset. As long as you do it in the
Mm-hmm.
same calendar year, there's no need to follow the 1031 rule book or use an intermediary, and you can essentially do a lazy 1031, which is a buzzword us millennials say. You wouldn't understand it, Dave. You wouldn't understand
Well, the nice thing about that play too
Mhm.
is you're not constantly pushing the can down the road. The,
Yeah.
the issue with the 1031s is eventually tax man comes due. Now, can you
Mhm.
push it forward until we're all dead and gone and push it to the next year? Well, maybe you can do something like that, but eventually it's going to come due. And the nice thing about what you're saying is you're recognizing some of that gain.
Mhm.
You're just using depreciation and other methods to
Mhm.
offset it,
Exactly. Yeah.
especially when we've got bonus depreciation.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. Yeah, yeah. Well, you could also swap till you drop, which is what a
Mm-hmm.
lot of high net worth and multimillionaires and billionaires do, which of course is doing a 1031 and continuing to 1031 and 1031, and essentially then you die and eliminate your tax bill as long as your estate is set up properly. But what's not as attractive with that is you never really get to touch the profit. You're just consistently rolling it, everything, not only the profit, but your entire investment, equity in the property. Now, you could pull out some money on a 1031 and pay your taxes and pocket some cash, but which people tend to do. But yeah, I mean the swap till you drop is tough because you never really get to touch that money. And it's just building your wealth and your wealth. Now you can cash flow on the assets. There's other you could refinance the buildings, right? And you access the equity that way, tax deferred. But of course, you got there's another buzz term, swap till you drop. You got your lazy 1031. Man, oh
Mm-hmm.
man, just so many.
Well, that's it's gets to the point where it's like dealing with my kids in text messaging, and I gotta look up what people mean by the definitions because it all changes. Swap to you drop lazy 1031. I go, man, I gotta check this just like when my kids
Yeah.
text me BRB, and I go, what does that mean? But
Hmm.
then again, I might be getting old. That goes to the the age more than anything else. But
Yeah. Yeah.
um,
Hmm.
well, and it is interesting, Aaron, because you can combine all these strategies together depending on what it
Hmm.
is. So if you're
Sure.
in a swap till you drop situation, often you're increasing the basis in the property each time. So
Yeah.
you can still potentially do a cost seg study when you do that swap, and
Hmm.
then even though the 1031 rules changed under the TCJA back, was that now? That's 8 years ago now. Forgetting how
Hmm.
long ago it was, but you can still include some personal property in that transaction as long as it's 15% or less. And it would be traditionally transferred with the property. You can transfer it, which means it doesn't affect the 1031 basis. So often you could combine the cost seg study with the 1031
Yeah.
and bring it all together. So depending on what's going on, whether it be 1031 exchanges, people investing in opportunity zones, everything, this strategy can come into play in all those areas and really almost supercharge the benefits from it.
That's interesting. Yeah, that's a good point. Yeah, I mean that's the amazing tax benefits of real estate. That's why 60% of billionaires' wealth is held in real estate because there's huge tax benefits. And all right, let me give you another softball here. It's going to be a little faster, but it's still a softball. How does cost seg impact cash flow and overall tax liability for property owners? How's that for softball?
Mm-hmm. Well, and so I kind of mentioned this in
Yeah.
the introduction. The
Mhm.
idea is simply that we're moving deductions around.
Mhm.
So I know if you meet with a lot of financial planners, I back when I was a standard employee and I would get my tax return at the end of the year. It changes once you're a business owner, and all the people listening know this. But back when I was an employee, I go out and I fill out my tax return at the end of the year, and it was I would think I was doing great because I get this big tax refund. I go, man, this is great. I'm getting $5,000 back from the IRS when I file my tax return.
Mhm.
You meet with any financial planner and they go, that's not good. That
Mhm.
just means the IRS held on to your money all year.
Yeah. Yeah.
Well, as I mentioned earlier, if we can accelerate depreciation deductions, push them into the current year and get them out of that 27 and a half year, we're
Mhm.
doing the same thing, except we're doing it over a difference between 1 year and 27 and a half, not 1 year of timing. So
Mhm.
what we're doing is we're taking that deduction and we're moving it forward. Now, it does require some things. Obviously, it requires that you have a tax liability.
Mhm.
Now, that's one thing with real estate, especially when we start talking about the Northeast and places where the property values are high.
Mhm.
Sometimes you're holding for the growth of it versus you're holding for that cash flow. So you have to have that tax liability. If you don't have a tax liability, you shouldn't be paying somebody like me to come in and do a cost seg study. It's a waste of your money.
Right.
But if we can do it, we can create this cash flow, which then you can then be using to reinvest in the property. You can be doing a lot of other things with it
Mhm.
that can then help grow your business. Now,
Mhm.
uh, I've been doing this a long time. When I started doing it, I had hair on the top of my head.
Mm.
I was much thinner. I was didn't have as many gray hairs. Of course, well, I say that I actually think I have less gray hairs now, but that's just because all the hair fell out. But um, I used to hear all the time that this was just a timing difference. And people would say, "Oh, do I care about it? It was a timing difference." And so we used to sit down with people and we'd go through and go, okay, here's what a gallon of milk cost 30 years ago. Here's
Mhm.
what a dozen eggs cost 20 years ago. Here's what a gallon of gas cost 10 years ago.
Sure.
We haven't had to do that in the last few years because people have seen how much a timing difference can affect their business. I
Yeah.
don't know about your clients. I know my clients specifically. If I come up to them and say, look, I could have saved you $1 million 2 years ago, or I
Mhm.
get you $1 million today, they're
Mhm.
all going to go, well, wait, I needed it 2 years ago. So I
Mhm.
could have reinvested it in something that would have grown because you've seen
Yeah.
how the economy changes. And that's what we're talking about, is talking about that timing difference that we can create
Mhm.
over time to make it worthwhile.
Mhm. That's great. That's interesting. Okay. All right. Very good. And so what are some like the common mistakes that you see real estate investors make when they're with their tax strategy in general?
A lot of it, to be honest with you, Aaron, it's not thinking it through.
Mhm.
So how we mentioned earlier this 1031 issue. So if you're doing 1031s, it's great when it matches up with your business. But if you're sitting there going, okay, I'm doing this 1031, but maybe I want to invest in something else long term.